All right, YouTube. My name is Jesse Vergali. Merry Christmas. Happy holidays. What can't you say today? Don't cancel me. Whatever you're celebrating, I hope that you're doing it with the ones that you care about. First of all, I just want to say thank you to everybody for your continued support of the channel. It means a lot to me that it's not just my mom watching.
Mommy! Mama!
So subscribe, like, write a comment below, and we'll get to it here. My episode with John Cochrane on working capital. For those that don't know, John Cochrane is an American economist. He was formerly a professor at the University of Chicago. He is now at the Hoover Institute and a senior fellow there. I thought it was topical to talk about the economy and how it relates to real estate, both residential and commercial, just given the question mark that is 2023 and what a wild ride the last 24 months has been. So we talked about interest rates, inflation, the Fed, monetary policy, and much more. So without further ado, my episode with John Cochrane. Ladies and gentlemen, you're listening to Working Capital, the real estate podcast. I'm talking with John Cochrane today. John is an economist and the Rosemary and Jack Anderson Senior Fellow at the Hoover Institute. He's a former professor of finance at the University of Chicago, Booth School of Business, and the Department of Economics, and the author of a great, fantastic blog that you should check out, The Grumpy Economist. John, how you doing today?
Good, thank you.
So we talked a little bit before the show, John, the podcast itself, the listeners, that we talk a lot about the kind of environment that we play in as entrepreneurs and real estate investors, and that being the economy. And you have a book that, I heard on another podcast, The Fiscal Theory of the Price Level, which we'll put a link to. And despite the title, and to scare anybody off, maybe you could give a kind of an overview of, first of all, maybe your background in economics and kind of the work you do, and then we could chat a little bit about the book.
Great. Let's see. I'm an economist, and I've been thinking about money and inflation since 1982, and I've split my time between thinking about that and thinking about stocks and bonds. So money, inflation, business cycle, stocks and bonds, and a whole bunch of other things. Being an economist is a wonderful thing because you can jump from one thing to another and actually make real contributions in lots of places. The book is called The Fiscal Theory of the Price Level. If you Google me and find my website, you'll find the book. The book is full of equations and designed to convince my fellow economists that they need to come over to this. There are some essays on the same website, which I recommend you start with. Fiscal histories I particularly like. No equations, and tries to tell a different story about where inflation came from and where it's going in the U.S. over the last, in the post-war period. The basic idea is, where does inflation come from? Not so much too much money chasing too few goods, but more importantly, too much overall government debt relative to what people think the government is willing and able to pay back. And if you're sitting on, say, 30 trillion in government debt, and you think government is good for about 20 trillion of it, what you do is you try to get rid of that. It's a terrible investment. What do you do with an overpriced investment? I think everybody understands this. What do you do with an overpriced house? You sell it. But if we all try to sell government debt, then the only thing we can do with it is buy houses, and we can put upward pressure on the price of goods and services. So that ultimately is where inflation comes from. That doesn't mean the Fed doesn't have a big role to play. So I won't bother you with equations, but interest rate policy still is quite important in figuring out where inflation will go, but it isn't everything. And when people don't fundamentally trust the government, there's really not that much the Fed can do about it. The Fed can kind of smooth it out for a while, but there's not that much. So I'll stop there, and we can see how deep you want to go into theory or into explaining the real world or into real estate.
Yeah, I think what would be interesting is that from, it wasn't too long ago, we were 07, 08, 09. It was a different environment from the financial crisis, but we had lowered interest rates to such a degree where people were starting to question the traditional economic framework, where we had interest rates at this low amount. We had quantitative easing, but we didn't seem to have any inflation. Maybe you could talk a little bit about what mechanisms were at play during that time, and if there is if there's a logical connection between that environment, what passed that and where we're at right now.
Yeah, so I don't buy. There's a lot of blah blah about how the Fed kept interest rates absurdly low for 10 years and so forth. Really, the Fed is not that powerful. The Fed cannot keep real interest rates low for actually 20, 30 years that they have been very low by historical standards. That has to come from the real economy. The Fed can move things around for a year or two, but in the end, very low interest rates come from real factors. And interest rates were low. Inflation was low. People were willing to hold the government's debt. The fiscal situation in the U.S. wasn't great, but there wasn't a lot of news about it. And I think at least not just 7, 8, 9, but also throughout the 2010s, when interest rates remained low despite deficits, I think the people holding U.S. Treasury said, look, the U.S. is a great country. And yes, the CBO reports are scary. But America will always do the right thing after we try everything else, as Winston Churchill, I guess, did not say, but he should have said. That fixing the long-run fiscal problem in the U.S. is not that hard. We just have to sit around and decide we want to do it. So sooner or later, we'll do it. I think why are we having inflation now? The government in the pandemic printed up $5 trillion in new money. Well, it printed up 3 and borrowed another 2 and sent people checks. And that is just massive. And I think people are starting to question, is the government really good for it? And we're seeing that not just in the US and tumult in the treasury market, we're seeing that in the UK. We may be starting to see that in Europe as well. So I think that kind of explains the difference. Now, I'm telling stories, but at least there's plausible stories here.
So when it comes to the understanding that in the entrepreneurial space and real estate and the greater economy, that we go through cycles, we go through time of growth, we go through time of contraction. Is this just an artifact of just the modern economy, that we're going to have ebbs and flows, and we're going to have times where, the getting's good and then times when it's not so great? Or is the chief goal, the ultimate goal, to have some sort of normality that plays out for a longer period of time?
I think everyone's goal is normality that plays out for some period of time. And you're asking a deep question, which I won't answer, is how much of fluctuation, especially in real estate, is natural to the economy? How much of it is some pathology of the private economy that some government might be able to fix someday? And how much is induced by government policy? I would say for real estate investors, batten down the hatches. We're on our way to a tough time. This one is pretty obviously induced by government policy, and not just monetary policy and fiscal policy. We saw certainly in 2007, 2008, how the regulatory environment encouraged booms and busts. And I think our current regulatory environment makes matters worse rather than makes matters better. Subsidizing the boom and then pulling everything back in the bust. But it's certainly where we're heading now. Is, I think, ask your parents and grandparents about the 1970s. I think it's fairly clear we have a burst of inflation that comes from somewhere. I think it comes from the massively overdone stimulus, but take your pick where it comes from. In the 1970s, we had inflation that came from fiscal policy. Johnson wanted the Vietnam War and the Great Society. And then we had also oil price shocks. Welcome to the 1970s. Get your flowered shirts and your bell-bottom jeans out, because oil price shocks get things going. The Fed is late to the game, and then the Fed slams on the brakes. Does that sound familiar? So I think it's fairly clear where we're going to go. Our Fed has woken up, and I think I can't really bet on where the economy is going, but I think I'm pretty sure what the Fed's going to do. As long as inflation remains high, the Fed is going to keep raising rates 75 basis points a shot. And so we will see what I don't know is if that will lower inflation, how long that will lower inflation, but the Fed's going to keep raising rates. I think it's fairly clear that is going to cause an economic slowdown, if not a recession. I mean, what they're trying to do is add just enough recession to offset the boom. You're trying to land a plane, they call it soft landing. You're trying to land a plane while the engines are going full tilt, which ain't that easy. So they're trying to add enough, and typically the Fed adds more recession. So I think it's quite possible we head into a recession, but the mechanism of what the Fed's trying to do is raise interest rates. And what does that hurt? That raising interest rates doesn't so much make you go out for burgers less often and soften demand for restaurants. Raising interest rates is designed to lower interest-sensitive spending. Okay, unpack Fed speak cowords. That means you, Mr. Real Estate. The design here is to raise interest rates, which lowers house prices, makes people less willing to sell houses, raises mortgage rates, makes it harder to buy houses. So, the whole point is to try to soften down a real estate boom. Not made any better by our country's ridiculous zoning, planning, and other bureaucracy. So I live in Palo Alto, where it's just infuriating.
Yeah.
Where house prices have been driven very, very high, not so much by too much demand, but by just the refusal of the government to allow supply.
So I was just speaking with you before the podcast. I was just coming back from San Diego. I live in Toronto and in Canada, and I find that Ontario here is pretty similar in policy to a lot of the California policies when it comes to real estate. I do want to ask about a specific thing here on inflation, but before we do, on that real estate, on the real estate topic, what we saw for the last few years was an extremely high, especially in our markets, in the major markets in the States, an extremely high push on asset valuation, specifically in industrial and multi-res, and low cap rates, which don't always follow interest rates, but the spread is usually somewhat consistent. I guess the question here is, we do have inflation. Now we have a business, real estate, where we do pass on inflation typically to our customers, i.e. renters. But do you think that and I take asset values, not just in real estate, but the stock market in general. I think the question often people have is, how do we have the valuations going one way from the asset perspective, but inflation hitting people in a different way on the consumer level, like the interplay there?
Yeah, thank you. Let me put on my asset pricing hat. I mean, one of the most fundamental things you have to understand with asset pricing is that when interest rates go up, values go down. When bond yields go up, bond prices go down. And so why are we seeing the stock market go down? Why are we seeing property values go down? Every asset, there's two things. There's the cash flow and there's the discount rate. Go, back to school. Here we go. Why? Because if an alternative investment can get you a higher rate of return, then you're going to pay less for this whatever investment we're talking about, a house or a stock or whatever. So now, in some sense, that's good news for very long run investors. When you see all asset valuations, stocks, bonds, real estate going down at the same time, what you're seeing, that effect is just the required rate of return going up, but it means the underlying cash flows are the same as they were before. So unless you have to post margin, Mr. UK pension funds, or unless you're cash constrained in some sense, the long run investor can just wait it out. It means that those the dividends you'll get from your stocks haven't particularly gone down. The rents you'll get from your house are in fact going up, and you can have rising rents and lower property values. Well, because the required rate of return goes up. So if you can just wait it out, those rents are there. Now, also the rents are rising. We have to put our inflation hat back on. If something isn't going up 10%, it's going down. That goes for everything. Anything that's not, if your rent is only going up 10% a year, then it's just treading water relative to inflation. If your wages are not going up 10%, they're going down. Hello, this is to my boss. So that, I think that's why it's possible both things, they go in opposite directions. Now, on top of that, we are, I think, heading into at least an economic slowdown, if not a recession. And that will bring pressure on the dividends and the cash flows on the rents and so forth. And real estate is, I shouldn't be telling you about real estate, you know way more than me, but location. Yeah. So there's all sorts of low rents in, Gary, Indiana, or places downtown San Francisco, places people don't want to be anymore. So it depends on being in the right place, which is where people still want to be, and where, unfortunately, you're on the wrong side of this, where governments don't let competitors build apartment houses to lower the rents on you.
Yeah. And I think part of it, to me, it seems it's the imperfect nature of especially real estate. We can be as sophisticated as we want on the commercial side, but I think the stickiness of prices is just that very real aspect that the bid ask spread is still there, and owners don't want to admit that they're going to have to write down to a certain extent these assets.
No, this is from an economist point of view, this is one of the most classic puzzles of real estate. Why is it in soft markets people cling to yesterday's price rather than, why don't we have just auctions? I'm going to say, people keep hoping for it to turn around on the downside. And so trading volume falls when the prices are going down. There must be something about not willing to recognize mark-to-market losses. Or
I think it's part of the reason that so many investors, I would take myself included, get into real estate. It's that I can't press a button and sell the thing. I think it's just the aspect that the cost, the selling cost is so great. But I totally get what your point of view, because we deal with in commercial real estate, and we're supposed to be these sophisticated investors, pension funds, REITs, and I think they cling to yesterday's or last year's price. I think that's
well, I know some of them, like university endowments.
Yeah,
have a cynical view. Why do university endowments like Stanford's invest in a lot of real estate and not just Vanguard total market portfolio and save themselves, in Stanford's case, $800 million a year on fees? Well, not marking it to market every year is very convenient for not saying, oh, we lost 20% of your money last year on occasion. But I don't know, that's a pet theory that may be false. So I shouldn't be so cynical.
So John, there's a quote that I know you're very familiar with, and it's I venture to guess it's somewhat of a misquote because I don't think it takes the whole quote into account, but it's from Milton Friedman, and it's that inflation is always and everywhere a monetary phenomenon. I think he was a little bit more specific, but that's usually the headline. What are your thoughts on that? Because I think you're kind of proposing that fiscal seems to be an equation, part of the equation that the monetarists have left out.
Yeah, I think Friedman was 90% right, and he was maybe 99% right in 1935 and 1965, and less so today. Most of the episodes that you look at, he was deeply historical and fact-based. He wasn't a big, lots of equations theorist. But most of the episodes he looked at were cases where governments were printing up money to finance deficits and therefore causing inflation. Why is Argentina, Venezuela, Zimbabwe having inflation? Not because their central bankers are too dumb to know what they're doing, but because they want to spend money and they can't tax it and they can't borrow it, so they print it. Now that is money, in that case, is just another form of government debt. So, fiscal theory and monetary theory agree entirely. If the government is printing up money to finance a deficit, you get inflation. And that's, I think, what we just saw. Now, the disagreement is much more subtle. Suppose the government drops $5 trillion from helicopters. You feel great, you go out and spend it, you create inflation. But suppose at the same time they tell you, oh, by the way, our burglars went to your safe and took $5 trillion of treasury bills out of the safe. Or more realistically, they send you a stimulus check for $10,000, but they also say, oh, by the way, your taxes are going up $10,000 today. Now, will that cause inflation? What I've just done is I've wiped out the question of wealth, the feeling that this stuff is yours to spend, and we've just changed it to you have too much money and too few bonds. So the composition of your portfolio is a little off. You have too many 5s and 10s and not enough 20s. Is that going to make you go out and spend like crazy? Not so obvious. So in fact, the core monetarist prescription is that all that matters is controlling the quantity of money. Don't worry about the quantity of bonds. So that if you take in money and give out bonds, or take in bonds and give out money, that's crucial for inflation. Whereas I think it's the overall quantity that really matters. And you can see that's a much less obvious proposition.
So his prescription, I think, I think generally was that from a policy standpoint was that we have some percentage, something similar to a Taylor rule, where we are going to raise kind of rates at a consistent percentage each year. I think if I remember, there was a video or quote. He said, "Just get a computer and replace the Fed." What was the perspective there? What was his intent, and what other policy mechanisms do you think, like writing this book, that we have at our disposal, or the Fed does?
Yeah. So to let me finish the last thought and add to your question. Friedman was right. There's nothing logically wrong about what he said, but it's a world where money really matters. Where in Friedman's world, you had to cash a check at a bank and get out cash on Friday if you wanted to eat dinner on a Saturday. So to let them use, there were no credit cards. There was no iPhone. And he was also thinking of a world where nobody worried about the US government paying back its debt. So if you look at the footnotes, it was always, oh, by the way, this only holds if everyone trusts the government to pay back its debt. So there's a very real sense in which, he gave a logically coherent theory for a different world. And we live in a different world. We live in a world where we have credit cards, where the money that matters, reserves, pays interests, and where we're a little bit worried about government debt. Now, let me now answer your question. Friedman advocated that the Fed should just let the stock of money grow at 4% a year, and just get rid of the huge building and the press conferences and the 15,000 economists and all the rest. Just let money grow at 4% a year. He did not argue that this was the best a perfectly rational, all-seeing, central planner could do. He just recognized that the Fed is run by humans, and they're going to get over enthusiastic, and they're going to. His analogy was, it's like a shower. You turn on the hot and it would get too hot, and turn on the cold and it would get too cold. Just leave it alone and it'll be okay. Because in his historical analysis, the Great Depression, as well as many of the post-war recessions, were caused by the Fed being too late to the party, and then not just taking the punch bowl away, but throwing ice on everybody or whatever. In 1980, the first problem with that is in 1980, the Fed did try to just control the money supply, and we found out it didn't work. So controlling the money supply, it led to a lot of volatility. And I think even Friedman recognized it. But John Taylor came along and said, well, the Fed doesn't have to control the money supply. It could be much more predictable. It can set interest rates. That's what our Fed does. Our Fed sets interest rates. It doesn't even pretend to control the money supply, because we discovered the real world is ahead of theory. The real world discovered controlling the money supply doesn't work. And theory is just now with my book and some others catching up. So John Taylor has this approach. Well, okay, the Fed's setting interest rates, but rather than sit around a table and burn the incense and wave the dead chickens and consult the astrologers and figure out what to do, Friedman was right. Being more predictable, not just figuring it out on a basis, would be much better for markets, for everybody, because as you know, as everyone is, everybody's guessing. All the volatility in the economy is guessing what the Fed is going to do. This is a deep point. What is the financial press about all the time? Is it about how many, the zoning, sanity comes to the zoning council of Palo Alto, or is it about people moving to Toronto is going to drive up housing prices? It's all about, what's the Fed going to do? What's the Fed going to do? What's the Fed going to do? So you can tell right there that the Fed, by making off-the-cuff decisions, is putting volatility in the economy. So Taylor came up with this Taylor rule: raise interest rates systematically with inflation, which was designed to work like the money growth rule, to make it very clear and transparent, to stop us guessing all the time about what the Fed is going to do. It isn't. Taylor does not claim it's perfect. He doesn't claim that the God that the Fed thinks it is couldn't do better. The all-knowing, all-seeing, perfectly rational economic planner, of course, could do better. He just recognizes the Fed's human. It's a bureaucratic institution. It's liable to groupthink. It's going to be late, and that expectations matter so much. Being clear and transparent about what you're going to do is better than the current just make it up as you go along. So there's your, sorry, you asked a question for history of monetary economics, and you got it.
So there is no Homo economicus out there at the Fed.
Homo bureaucraticus is the best we can hope for. And we all criticize the Fed. I criticize the Fed, and I think too harshly, because I know most of the people at the Fed. And let's just be clear: these are really good people. These are really smart people. The 1,500 PhD economists, I think that's the number, that they, as well as the ones at the Bank of Canada, are really good, really smart people. There's no corruption here, but they didn't see the biggest inflation of your lifetime coming. So they've got a whole, staff of their mandate is inflation. They have a huge staff of economists, the best people in the world at it. They just couldn't see it coming. There are limits to what bureaucracy can do. So simple and transparent has some advantage, not because people are bad or corrupt. It's just, the best bureaucracy in the world can't, we saw the Soviet Union fall apart for just that reason. Planning don't work.
So I had a podcast, I think about a year ago now, two podcasts. One was the name is escaping me, but it was a professor from George Mason on the one hand, and on the other hand, it was a bond trader locally here. And we were talking about modern monetary theory. And, for listeners, look it up. I hate to do that, to have a huge explainer, but basically what you can just tell by the nature of those two conversations, or maybe not. One was very much in favor of it. One was questioning its existence. Just high level, maybe you could kind of get your view on what modern monetary theory expounds or tries to expound. And has this last year or last 2 years, has that been the nail in the coffin for them, or has that bolstered their theory? How do you think that has played into what we've seen now as 2-second blurbs in the news? That was this really, from my perspective as a layperson, kind of a fad of economics for a while.
Yes, it was. If your listeners are interested, I wrote a review of Stephanie Kelton's book in the Wall Street Journal, which you can find either there or on my website, which goes into much more detail. Modern monetary theory was a fad. And one way of noticing it's a fad is that they wrote popular books. 3/4 of Stephanie Kelton's book is about the wonderful ways the government can spend printed money and how desperately important it is to spend the money, not so much why printing it won't cause inflation. And it was a bunch of sort of ideas. It's interesting, you look at the citations, they stop in the 1940s. There was some ideas warmed over from the 1940s with zero contact with anything anybody has done since. Now, maybe everything we've done since 1945 in economics has been wrong. Fields in the social sciences go off on fads before. I think Keynesian economics was one big mistake too. But at least you have to, if you want to persuade people, you have to at least show that what they said and why it's wrong. And it was superficially plausible. There were some ingredients. You can take some good ingredients and just because the soup is rotten doesn't mean every ingredient was rotten. So they had one insight that governments, one of their things was governments that borrow in their own currency don't have to default because they can just print up money to pay back the debt. Yeah, that's right. And if that causes inflation, they can just raise taxes to soak up the money. Yeah, that's right. But they took that and merged those with a whole bunch of things. Then the rotten parts of the soup go in to make the claim. I think Kelton said there always is slack in the U.S. economy. That's a quote, and the present tense of the verb is also a quote. And we just found out the end of slack in the U.S. and Canadian economy. So we're done. There is not always slack in the U.S. economy. If you print up a lot of money and send it to people, as Kelton asked, as all the modern monetarists said, print up money, send it to people. Don't worry, there won't be any inflation. It's the clearest prediction you can ask anyone to make. They made it. Boom, we printed up money, sent it to people, and what do we get? Inflation. So I hope that one goes on the dustbin of history, but it was never serious. And certainly you should look in today's media world. You have to learn to be an educated consumer. And one way in which you're an educated consumer is to look at a theory and ask. Now, the theories that are accepted by the mainstream are typically wrong, and academia is full of all sorts of politically convenient theories. But if it's completely out of the mainstream, that does raise an alarm bell that you should ask. And this one was one such. And it's also, if you can see that it's all totally motivated by a political agenda, then that should also raise some alarm bells.
So I have one of my favorite books here by Joseph Schumpeter. Recommend anybody that's never heard of Joseph Schumpeter, check out his work. I think, you'll hear terms like creative destruction. One of his favorite quotes, just on your point of politicians, I always was politicians are like bad horsemen who are so preoccupied with staying in the saddle that they can't bother to figure out where they're going. And it's unfortunate that a lot of the policies that that we're trying to get at here are, I guess, tied up in the political process.
If I could just, so it's fun to make fun of monetarists, but I think we need to recognize what a watershed moment inflation is for much more serious and well worked out economic ideas. For 10 years, all of the worthies of economic policy, all of the government agencies, all the alphabet soup of international agencies, we're talking about secular stagnation, that we just have lack of demand, that we need more fiscal stimulus, that the key to prosperity is to borrow or print money and hand it out. Don't worry about the supply side of the economy whatsoever. Even Janet Yellen herself at her congressional testimony was asked about, should we run another $6 billion of government spending? And she said, don't worry about it. Interest costs are so low, interest rates are so low, you can make the payments. I think one of the greatest fallacies of real estate, let's get back to real estate, is don't worry, is you look at the monthly payment. Here's the big McMansion. Oh, but I don't have a job. Don't worry about it. You get this adjustable rate mortgage with the teaser. Look at the monthly payments. You can afford the monthly payments. Well, Janet Yellen went up and said, we can afford the monthly payments. Don't worry about going big. That has hit a brick wall of reality with inflation. And here, these are all of the, Larry Summers, for example, who to his great credit saw the inflation coming before anyone else. But he had spent 10 years saying secular stagnation, our problem is lack of demand, borrow. And where it turns out that supply wall, boom, was a lot closer than we thought. It was about we were 1% away from the supply wall in the beginning. It wasn't 10, 20, 30% away from this. So this is a watershed. A bunch of ideas by very respectable people were totally wrong. And our economic challenge now is much harder. It's get the sand out of the gears. Increasing supply is not about throwing money on it. It's not about sending people checks. It's about fixing the zoning code. And can you rehab a commercial building in Manhattan to be apartments? No, because the zoning doesn't let you have bedrooms on the interior. This is a great Matt Iglesias point. You have to fix every single thing that's wrong in the economy. That is totally different, but that's where we are. So this is a big, big moment.
Yeah, and even on the Keynes side, I don't the context of it, but the idea that markets can stay irrational longer than you can stay solvent. I think from the real estate perspective was just this idea where you saw very sophisticated investors buying prices at asset values where it just made no sense. There was negative leverage in some situations, and just this idea that there would just continue to be a hockey stick graph, especially here in this city and certainly in other major markets in the States.
Well, a fact of all such booms is you got to ride the bubble while you can. And you can make a lot of money buying, flipping, hoping to God it doesn't crash before you can sell the darn thing. And that can go on for years and years. And if you just sit that out, if you say, property's overvalued, stocks are overvalued, well, 3-4 years go by and all your buddies are getting rich and you're sitting there, if you go short, losing money on your short positions, if you just sit it out, playing golf while they're all getting rich, it's tough to do. Especially if you're, working on someone else's behalf.
So, John, I'm just want to be mindful of the time here. I do have a question. In chapter 4 in your book, you talk about debt, government debt, and I wanted to kind of go a little bit more granular. I don't know the figures for the States offhand, but I know that Canadian household debt is debt to disposable income is quite high. I believe it's 1.84 for every dollar Canadians have in consumer debt. What's your take on that microeconomic aspect of the family debt within the family, and then that impact into kind of this grander, macroeconomic environment that we're in? Is it something that you look at?
Well, I can offer some sort of general. So there's government debt, which has to get paid back by raising taxes, but not raising taxes really by economic growth. Your only hope for the government paying back its debts is if they let the economy grow. Because if you raise tax rates, that kills the economy. So you kill the tax base, you don't get a lot of taxes out of it. Now, private debt is a different matter. Let's remember, your mortgage is my pension. So everyone's liability is someone else's asset. And it's funny how, all of our economic policy, blah, blah, we simultaneously love and bemoan the same thing. On the one hand, too much debt, people can't pay it back. On the other hand, not enough debt. Send more debt to my constituents so they can buy houses. Which is it? Government wants us to consume more, but it also wants us to save more and to pay more taxes. How's that happening? Financialization is great. Economies grow because entrepreneurs can borrow to finance new businesses, because real estate developers can borrow to build apartments for the rest of us. They're doing us so, I don't know why they're so maligned. They do us a wonderful service. You want to build your house on your own? How about somebody who knows what they're doing? Do it, but they need to be able to borrow to do it. So debt that can be paid off is not so much a problem. Now, problem comes in when debt can't be paid off. But risk and return, guys, I think we need to get back to an economy where risk, we all understand if you buy Tesla stock and it turns out that hydrogen and not batteries is the wave of the future, or China shuts off the supply of batteries, you're going to lose your money. Or, GM turns out to know what they're doing, you're going to lose your money. We all understand equity holders losing money. Now, somehow, if you buy something called debt and you're getting a 5% return where everyone else is getting a 2% return, you're not supposed to lose money every now and then. So, even debt is a great thing. Risky debt's a wonderful thing, but caveat emptor. We need to understand as a society that making risky loans is a great and wonderful thing, but you're going to lose money every now and then, and don't go crying to grandma government every time you lose your money. Debt is, why do we worry about too much debt? We worry about it if it turns into a financial crisis. And that's that's a problem. That's what the Nobel Prize just was given to Diamond and Bernanke and Phil Dybvig about.
Which I believe you just read or wrote a blog about, right?
Yeah, I just wrote a blog post about it, which is, we as a society need to stop having financial crises. Now that means the debt must be able to lose money when it defaults in a way that isn't so incredibly painful for the society as a whole. And that, I think, is a failure of government regulation. Why do we regulate banks? Let's look at a bank's asset portfolios. The bank's asset, and compare it to, Tesla. Now, whose assets are more risky? Whose cash flows are more risky? A bank or Tesla's? By 3 orders of magnitude, Tesla bank has a portfolio of government guaranteed loans. I mean, possibly, where are all the regulators? The regulators are all looking at the bank. Now, why is that? Answer, because banks are leveraged up to the hilt. And if they lose enough money to go under, they're kind of big monopolies, and our economy loses the capacity to make new debt. So why is that? We need to get the leverage out of the banks, and then you get to a financial system where people can default on debts, and it doesn't bring the whole thing crashing down. So debt's good. Default is good. Let it happen. Default is reorganization. We just need to not, we kind of have a hostage here. The banks have taken the whole economy and holding it hostage, saying, you government can't let anyone fail or else. And it's our political, and even the Fed, a financial crisis is not the possibility that somebody somewhere might lose money someday on some investment. No. Risk and return, entrepreneurial capitalism, lose money. Financial crisis is when there's a run on short-term debt, and that brings down the banking system. We can fix that.
It's you remind me of we'll put a link to it. A really good, I don't know if it was an essay, but it was years ago. Thomas Sowell wrote comparing the American Depression and the branch banking system that we have in Canada, because oftentimes people think Canadians that we have these 5 large banks, which we do, or 4 depending on who you're asking, but we have an extensive branching system, and it was interesting to see the difference of branching where it wasn't allowed in states during that time, I guess right after the Depression. But we'll put a link for anybody that's interested.
Now, this is a great important, and I want to say something nice about Canada. This is what Ben Bernanke got the Nobel Prize for. He said, in the U.S. in the Great Depression, why was the Great Depression so bad? Well, because all the banks failed. Now, why did the banks? And then once the banks failed, not all the banks, sorry, I'm exaggerating. Many banks failed in many places. And when the banks failed, they closed down. And the people in those banks who knew in Lincoln, Nebraska, who was good for it and who wasn't, who knew how to make loans, they were unemployed. Why did that not happen in Canada? Well, because there are many ways to stop a bank run. And one of them is if a local bank fails, somebody else can come in, a large national bank can come in and buy up the assets, keep the people who know how to make loans employed, stiff the creditors, stiff the stockholders, but keep the operations going. But that needs the U.S. had prohibitions on branches. It had prohibitions on interstate banking. There was no way, all the mechanisms of saving a bank and keeping the profitable parts going didn't exist. And they did exist in Canada, which is why your Great Depression was a whole lot better than ours. Now, that doesn't mean the only answer to this is to have a monopolized banking system with 4 big banks that kept Canada out of a crisis in the Great Depression. But that also leads to a certain amount of financial sclerosis. And so I don't want to endorse crony capitalism as the only answer, but it did work better in that circumstance.
Economics, real estate, and Canadian banking history. John, I think we covered it all today.
Thank you. It's a great pleasure.
John, for individuals that want to connect or reach out, where can we send them? We'll put a couple links in the show notes.
My website, johnhcochrane.com. And my blog, The Grumpy Economist. And if you just Google John Cochrane, I come up first.
This is Working Capital. John, thanks for being a part of it.
Thanks. Great pleasure.